Whenever we get our paychecks, we'll glance down and we'll take a look and see how much money was taken out due to taxes. And we'll often wonder if there's anything that we can do that would allow us to reduce the amount that we pay each and every month. Well, in today's video, I'm going to be going over 4 ways that you can legally reduce your taxable income. I've personally utilized each one of the methods that I'm going to talk about in today's video, and they have worked well for me, and I have no doubt that they'll do the same for you. The first way that you can legally reduce your taxable income is by contributing to a health savings account, which is often referred to as an HSA. Now, this type of account is essentially a personal savings account that allows you to contribute money into an account that could be utilized for either current or future healthcare expenses. The funds that you contribute to this account are tax-free, and you will not have to pay any taxes on this money, provided that it is used to pay for a qualified medical expense such as a deductible or an insurance copayment. You can contribute to an HSA provided that you are enrolled in an HSA eligible plan, which would be something like a high deductible healthcare plan. As of 2024, the maximum amount that you are eligible to contribute to a health savings account for an individual person is $4,150, and it's $8,300 for a family. Once you have this account set up, it is yours to control, and the funds within the account never expire. And as long as you utilize it for qualified medical expenses, you'll be able to pull that money out tax-free. One of the best features of this type of account is the money that you contribute can be invested into the stock market so it can grow over time. So you can take the money that's inside of this account, invest it in an index such as the S&P 500 over the next 10, 20, or 30 years, and you will be able to pull all of the money out in the future tax-free, provided that you use it for a qualified medical expense. So not only do you get to reduce the amount of taxable income in the year that you're contributing to an HSA, you can then take that money, invest it into the stock market where it has an opportunity to grow over time. Now, the second way to reduce your taxable income is by contributing to your company's 401k. And as of 2024, the maximum amount that you can invest in your company's 401k is $23,000. Now, the great thing about the 401k is all of the money that you invest into your account is done so with pre-tax dollars. In the United States, we have a progressive tax system, meaning that the amount of taxes that you pay increases based on the amount of money that you've earned throughout the year. And as of 2024, the first $11,600 that you make on the year is taxed at 10%. And the money that you make from $11,601 all the way up to $47,150 is taxed at 12%. And from $47,151 all the way up to $100,525 is taxed at 22%. So for example, if we are making $55,000 a year and we want to invest $10,000 towards our 401k within the year, it would reduce our taxable income from $55,000 down to $45,000, which would take us out of the 22% tax bracket and move us down into the 12% tax bracket, which would be the highest amount of taxes that we would have to pay on the income that we earn throughout the year. So not only do we have an opportunity to reduce the amount of taxes that we pay by taking pre-tax dollars and investing that in our company's 401k, some companies will also offer their employers with a match if you participate in their retirement program. So on one hand, you get to reduce the amount of taxes that you have to pay every single year, and you also have an opportunity to double the amount of money that you're putting into a retirement account. So to me, that's a win all the way around. Now, the third way to legally reduce your taxable income is by contributing to a flex spend account or an FSA. Now, in these types of accounts generally fall into 3 buckets. The first being a healthcare account, which would allow you to pay for medical expenses such as co-pays, and co-insurance. The second would be a dependent care account, which would allow you to pay for things such as infant daycare. And the third account would be a limited FSA, which would allow you to pay for dental and vision type expenses. Now, it is important that I point out that if you are enrolled in a high deductible healthcare plan and you have an established health savings account, you are not eligible to contribute to a standard healthcare flex spend account. However, you are eligible to contribute to a dependent care account and a limited care account. You have to remember that the limited FSA allows you to cover medical and vision expenses only, and the dependent care FSA will allow you to pay for child care expenses. And the amount that you are eligible to contribute to an FSA as of 2024 is $3,200 a year. Now, the one drawback with having a flex spend account is that any of the money that you contribute into that account has to be utilized in the year that you contribute the money into, or you lose it forever. Now, the fourth way to legally reduce your taxes is by donating to charity. Now, not only do you get to do something positive for your neighborhood and for your community, you also are eligible to get a tax write-off for all of the items that you donate. So one of the things I want to point out about this is that whenever you donate items and you plan to write that off at the end of each year, you want to make sure that you keep an itemized list of all of the things that you donate. Prior to making your donation, it would be a good idea to go to a site such as irs.gov so you can get a good evaluation and a value on the items that you are donating, so you could make sure that you're accurately capturing the value of the items that you donate. You'll also want to make sure that you keep any receipts for the items that you donate to make sure that you can give that to your tax professional at the end of each year. It's important to note that any gifts that you give to friends and family members are not tax deductible. So you want to make sure that you account for that. If you like this type of content, make sure you check out the next video.